Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 16th, 2018. I wanted to take a look at the U.S. index futures and the tracking ETFs. So we'll look at ES, NQ, those are the S&P 500 and Nasdaq 100 E-mini futures, as well as QQQ and SPY. I know a lot of you trade the SPYs and the Qs, and even I do at times, but I like to use the futures as well. Keep an eye on those. Sometimes it gives you a little more insight to some of the developments on the chart, so that you don't pick up on the ETFs, which only trade during regular trading hours, or at least most of the charts are going to plot that. So these futures trade around the clock. Well, and then we'll just wrap up by looking, because I really think it's worthwhile right now to look at just a handful of the top components of QQQ and look at their charts, and I'll share my thoughts. So let's dive in. This is the ES 60-minute chart. So these are S&P 500 index futures. There's that breakdown we had the other day. Then we went on to take out that resistance. I know these numbers are real small. I need to increase those for the video size. That's 27, 28, 67. So we'll call that 27, 29. That is resistance. You can see back here to the left of the chart as we go back here. Let me grab a drawing tool. You can see it capped all these reactions right there. Then we also had some reactions over here, and more recently here we broke down below after breaking the wedge, back tested a little from below, and then gave up the ghost. So there's that, that's that target I was eyeing right there. Was that 2698-ish? Pretty much hit that and bounced. So this is it in a nutshell. Here we are on the futures, at least. We have broken down from a very clean, well-defined bearish rising wedge, uptrend line, complete with negative divergences at the highs. That has played out for a correction, and I'll tell you, it's met the measured target. One of the easiest measurements for a wedge, just take the widest part of the wedge and then add that to where the wedge breaks down, and that gives you a measured target. Now, sometimes you go a lot more than that, sometimes you fall shy. Again, these measured targets on chart patterns are just that, and some can get a little more complex on wedges, but I just wanted to point that out. So right now, or at least yesterday, I can tell you on the NQs, that's where I covered in my short and went long for a quick bounce. And I mentioned to you guys on the site in the trading room I had to leave for the day, so I just closed out, and I'm still on the sidelines here. So that's it. Let's watch this level. This is my point. We have bounced back to resistance. There could be more. This could morph into an ABC down, or more downside on the correction with that first leg down, this initial kickback rally, and maybe we take another thrust down. And you can see I could certainly add a resistance line. Let me do that for you right here. For those ES traders, grab a horizontal line and tell you right about, boom, right there. That would be my next target. If we happen to fail here, my degree of confidence isn't so high, and I'm going to show you why when we get to the charts of the leading stocks in the S&P and then Nasdaq 100. 2683 roughly, that level is there. So let's see what happens. If we start to turn down here and we fail to surmount that level, we could very well take another leg down. Obviously, yesterday's reaction lows or that 698-ish level, that would act as our first support level. We might get another reaction there if we do turn down. And again, if we take out the highs, that high, we might go up. And if we do, keep in mind, we have the potential here to still go on, take out the recent highs, and keep these divergences intact. So that is, and at this time would be let's say, my preferred bullish scenario if we're going to go that route. And I'm telling you, my confidence isn't very high, so I'm just sitting on the sidelines seeing how this plays out right now. But if we do pop above there, we'll probably take out that previous reaction high, and in doing so, we'll probably get another divergent high there, a larger divergent high. That would set the stage for a move down to that additional target I gave you there. All right, let's move on to NQ real quick. Similar story, a lot of lines here, but these horizontal lines. There's the wedge, clean wedge, breakdown, and now we've bounced back to this level here. That's 69.5250 on NQ, the E-minis, and you can see once again, if I take these lines that we already have in place and I were to extend the divergence lines that we had at the recent highs, and let's just move them up like this. Let's just play this game for a second. So that gives us room here if we do pop and pop up to the new high or above the recent highs, up to or above, I should say, because all you need to have divergence is equal prices making equal or a higher high with the indicators making lower highs. That's negative divergence. So there it is. That's my most optimistic scenario right now, and I'm sort of leaning that way, but I'm not playing it. I just don't think the risk reward to try to eke out a couple percent is worth the risk of waking up to maybe a sudden gap down. If you trade futures, you can set your stops. They're liquid throughout the trading session, so you can be stopped out overnight and not have to wake up to a big gap down like QQQ. But if you are trading the ETFs, keep that in mind. Sometimes the futures make a big run overnight and into the early morning session, and then boom, you open with a gap, which can bypass any well-placed stop on an ETF like QQQ or SPY. All right, speaking of those two, let's look at SPY. Busy chart, forgive me. I know there's a lot of annotations, but I left this one. I wanted to point this out. In one of the recent videos, I pointed out this right here. I'll turn the annotations off for a second. We had this potential bull flag pattern. I didn't expect it to play out to the full distance, but I mentioned that as a possibility, and I showed you the measured target, which is simply you take the distance, what they call the flagpole, the move leading up to the flag, and you add that to where it breaks out. So on that chart from that video, I guess it was a week or so, whenever we were back here, that was back on May 8th, that around then, I had that line right here. We hit it to the button. There's the flagpole. And so if I drag that same line, add it to the bottom of the flag, the lowest point of the bull flag before we broke out, which is right there, boom, that's about what we hit yesterday. And that also, not by coincidence, these things often, it never fails to amaze me, I should say. Here's that gap. The gap on SPY was smaller. There's a couple gaps there, actually, quite a bit. So we hit gap resistance, backfilled the gap, and that's where we reversed. Now, when I look at the SPY charts as well as QQQ and some of the top components, what stands out to me is we have the PPO, which is a momentum indicator, is starting to curl up. It's poised to make a bullish crossover on any more upside, and it's still below the zero line. I have these boxes here. I use that 9 EMA. If you followed me for a while, you know this. I like that as a trend indicator. So that's the dotted white line when it's above the zero line, the trend in the SPY or whatever security you're using, if it works well to this. I don't blindly use it on every security. Some stocks, certain stocks or ETFs or sectors, you might notice this doesn't work as well as defining the trend. But when that 9 EMA is below, the trend is bearish. And again, you can just follow up. You can replicate this on your own charts. And if you don't have a PPO, MACD is very similar. So you'll get roughly, the same crossover points. It's not exact, but it's a close cousin to the PPO. And that's that. Actually, I should have extended this one out here. At the time, I must have been doing the analysis, just indicating the trend was still bullish. And that's it. So we had a little bit of some whipsaws here. It did cross down bearish, gave a sell signal. But since this point right here, it crossed bullish. Wrong tool. Try to grab an arrow tool. We crossed over bullish here, that white line again, and it's still above the zero line, indicating that the trend is bullish. So this may have just been a pullback to be followed by another uptrend. However, sometimes what looks like a bullish crossover, or even after you get one, these lines can turn down. Anything can happen. So remember, I just showed you at ES and NQ, we're at resistance. On SPY, certainly some resistance there. You can see that gap right there. We pretty much backfilled yesterday's gap, and I believe that was yesterday's gap. Yeah, yesterday's gap. So there's resistance on SPY. Again, this indicates we may power on through there. I don't want to bet on it because there's just not enough meat on the bone, like I said, for long. And right now, there's some things like this giving me pause. Now, if we fail here and these potential crossovers do not materialize, there's the PPO we're on QQQ now. I've jumped over to the QQQ 60-minute chart. You have a bullish crossover in play right now. You have that 9 EMA, the signal line on the PPO, still above zero, and it has been since this point. So by that trend indicator, and I often talk about this, once you cross above or below, the zero line often works as support and resistance when tested from above or below, and that's what we're doing here. This is a test from above with that PPO line curling up as well. So we may get another push up here, but if that gets foiled and we cross back down, Then we take that other leg down, and for you QQQ traders, you want to know where I think we're going if that happens, or if we make that marginal new high that I just talked about. That's my next target there, about 164.54. That would be my target if we fail here soon, or as laid out in the NQ and ES scenarios, we go on, we make a marginal new high. You can see here there's plenty of room to extend these divergences that are in place right now. Should QQQ want to pop up above these the recent highs here, um, maybe make a run at those all-time highs there back from early March, mid-March, and then turn back down. So that would be my bullish of the two scenarios. Slightly leaning towards that, but remember, you can reverse anytime you take out or hit that previous reaction high, especially if you take it out right around 170.78. We'll still have some divergence. So if we reverse from there, afterwards, those divergences would be confirmed. So, near term, I just don't see I don't think it's a good time to be actively engaging the markets long or short. We'll go through the top components of the Nasdaq 100 real quick. Now I'm just sticking with the 60-minute time frames. There's not a lot of new developments on the daily or weekly charts worth noting at this point in time. So here's Apple, the largest component, and this was pointed out recently. We had this divergent high, negative divergence, played out for a pullback, but pretty shallow. You can see we grabbed support here, that 183.89 level. That's around that previous reaction high there, plus these reaction lows right here. And like everything else, it's almost same story on all of these. Usually the charts of the top 10 components of the Nasdaq 100, usually, not always, but usually they look very similar. So you'll see the same things happen if this plays out. And that would be, again, a case where we may rally here for the rest of the week, possibly into early next week, and then reverse, putting in that divergent high on the 60-minute. That would set up a more objective short entry, which I think has more downside than that leg down we just had. So a pullback target on Apple. Well, I'll give you those on the site. I'm going to post this as public content because I'm covering general broad market analysis. Anybody on the site, a member, if you want to know price targets or sell signals or buy or sell triggers on any of these stocks or anything else, just let me know. Next one up, Amazon. This one, what stands out to me right here is Amazon's really having a hard time right here around this level. You can see here, I just added a line there about 1615.88. So we'll call that 1616. So far, the stock has struggled for the last couple months to get through that level. We had a brief pop there, but it failed. So that's a level to watch. Obviously, if it can take it out with conviction, nice daily close above it. This was only a 60-minute candlestick here, but either way, even if you get a daily close, you want to see impulsive and you want to see some follow through. What else stands out? Well, same story. If we do get that pop to new highs, however, be careful because there is divergence building here. So we may have a divergent high in Amazon as well. Next one up, Alphabet, GOOGL. We'll look at the Class A shares here. And here it is, 60-minute chart. This one trades pretty well to the technicals. You can see these, divergent lows. There was a divergent low and a rally. We were oversold here. There's a trend line. We rallied, broke trend, back tested, fell down, culminated in a divergent low. So same old stuff. These are the 60-minute charts. These are swing traders charts. These moves measure, roughly that's about a 20% move right there. From that drop down to the bottom, that was about a 17% move. So even if you're getting these smaller moves, in a week, couple weeks, 7%, it's worth it. That's why I do these videos. I know some people prefer to trade individual stocks. Now, so we had the divergent high. We broke down. We pretty much met the wedge projection or measured target. That wedge wasn't very wide, and that's about how much we fell right there. So maybe that's over. And also worth noting is that the PPO is still like as with the QQQ and SPY, it's still above zero and it appears to be turning up. So this is really a kind of a make it or break it area with the ES and NQ and SPY and QQQ for that matter at resistance. So we're either going to take another leg down here and it'll most likely happen very soon, or we're going to go ahead and, like I said, power on up, maybe make another new divergent high before the next leg down. All right, moving on. There's only a couple more. I'll skip the other share class on Alphabet. Here's Microsoft. You can see down here on this on the indicators, we have negative divergence with prices right here making higher highs, a series of higher highs, and the indicators making lower highs. It's not very steep divergence, but it is worth noting. So there it is, 3 consecutive higher highs. So the trend is certainly up, as is, the higher lows here. I might be able to play around with this trend line a little bit and come in right under this area that looks a little bit like flagging type action. There's not really a flagpole there to qualify that as a bear flag or a bearish pennant because the move down leading to it wasn't very large or impulsive. But either way, just watch Microsoft because it is wedging up here with divergences. So the near-term trend is up. It took out that previous reaction high, but you can see lack of follow through. That wasn't very impulsive. This is not a convincing breakout, and it's failed, not to mention that. So again, I'm referring to that previous reaction high, these highs here. So this seems to be a big level right around 97.20 for Microsoft. If it can power up on through there, power through these divergences as well as QQQ and SPY, obviously that would be bullish. But if they fail here, the charts, are indicating there is a potential certainly for some more downside. Here's Facebook. That was a pretty significant, bearish rising wedge, divergent high, negative divergence on the PPO at least. We burned through the divergence on the RSI. However, we had an extreme overbought reading. You can see going back to the left of the chart, usually when Facebook hit overbought, crossed that red line, the 70 level, a top was in or shortly thereafter. In this case, we're extremely overbought. The stock really hasn't corrected much after breaking below that wedge, but there is potential for more downside. So that's not one of my favorites. I just wanted to kind of cover all these to give you an idea where things may be heading. So here's Intel. I wanted to cover a couple more that look good. Or not look good, but some of the things on the chart stand out to me. So there's Intel. I'm trying to force it here. Roughly equal highs, technically not divergence. So let's just leave that line off like I had it and look at the PPO curling up right at the zero line. These were divergent highs right here, here, and here. They led to corrections. This one had a back test first and then worked its way down. And then three more, I think I'll wrap up. Cisco, there it is. We had a divergent high right here. Actually, that divergence extends right here to this point. We went on to make a slightly higher high up to right here. So at those crosshairs, that's where we take this divergence out. And Cisco's starting to roll over. So like I said, I can't, I certainly can't make a screaming case to be long here. There may be a little more upside, but with a lot of divergences and everything that's gone on in the market, and the fact that we're at near the upper end of the trading range throughout 2018, I just don't see a reason. I don't think the risk reward warrants being aggressively long here. And I can't make a screaming case or a very strong case to short. The other day we had those wedge breakdowns, and then they followed through the next day. So that was probably the best shorting up we've seen at least in a few weeks. Here's Nvidia. Negative divergence, there it is on the 60-minute, and sure, we had, same story here. We had a falling wedge with positive divergence, and that, boom, we broke out, and that sparked a rally. So negative divergence, that's started to play out so far, and what I'm looking at here is a gap on Nvidia right there. Boom. So that gap's either going to be backfilled, as most gaps are. Nvidia, I think it will be. As you can see here, the PPO is crossed below the zero line. It looks like the PPO line was trying to make a bullish crossover, but it's starting to roll back down. So that looks like a rejection right there. So even though we're oversold, and that's when you want to, it's not really objective to short, in my opinion. There's not a lot of meat on the bone. The only possibility I see here, if you want to short, keep your stops relatively tight. This does appear to be flagging action, with this being your flagpole. So if we broke down, we might get more than a gap fill. If that flag plays out, it's going to take us down somewhere around there. But that's it. So let me just say this. I favor a backfill of that gap from here. But for me, looking at risk reward, even if the gap is backfilled 2.9%, I don't see resistance up here which is exactly 2.9%. That's the top of that gap. So I don't take trades with a 1-to-1 RR. So I'll just leave that one alone for now. And then finally, and I'm going down in descending order of market cap within the top components of QQQ. This one's Comcast. I'll actually go over this on the site. There's some things I see on the daily chart that I like, and I've actually posted this one on the site recently as a potential trade idea. So we'll wrap it up here. That's what to look for. We're kind of at levels where it wouldn't surprise me to see a little bit of a pullback here first. Actually, nothing would surprise me. Let me just make it clear. We can roll off these levels. This could be the initial kickback rally in a deeper correction that started with those breakdowns from the wedges earlier this week. Very possible. So that's my thoughts. And if we start to break down, we start to take out some support levels, maybe there'll be another potential short entry. And if you want to short here, let me just say this before I wrap it up. If you do think there's another leg down, we are at resistance on QQQ and SPY, especially on NQ and ES. It was very well defined there. So you can certainly short here with a stop not too far above, a relatively tight stop. 1%, maybe even 0.5% or 0.75% above current levels, that would offer a decent risk reward. If you get stopped out, you lose a half a point or a point, but you have the potential to make 3 points, or at least on SPY, or that's QQQ, I'm sorry, that's about 2.6% downside there. 2.7% or so. So not a bad risk reward setup there. Let me wrap the video up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.